against payment of the proceeds. These services will cost a little extra, but they should be well worth the expense in terms of safety and peace of mind. This advice may be disregarded, as no longer called for, after the investor is sure that all the problems of stock exchange firms have been disposed of, but not before. Investment bankers. The term investment banker is applied to a firm that engages to an important extent in originating, underwriting, and selling new issues of stocks and bonds. To underwrite means to guarantee to the issuing corporation, or other issuer, that the security will be fully sold. A number of the brokerage houses carry on a certain amount of underwriting activity. Generally, this is confined to participating in underwriting groups formed by leading investment bankers. There is an additional tendency for brokerage firms to originate and sponsor a minor amount of new issue financing, particularly in the form of smaller issues of common stocks when a bull market is in full swing. Investment banking is perhaps the most respectable department of the Wall Street community, because it is here that finance plays its constructive role of supplying new capital for the expansion of industry. In fact, much of the theoretical justification for maintaining active stock markets, notwithstanding their frequent speculative excesses, lies in the fact that organized security exchanges facilitate the sale of new issues of bonds and stocks. If investors or speculators could not expect to see a ready market for a new security offered them, they might well refuse to buy it. The relationship between the investment banker and their investor is basically that of the salesman to the prospective buyer. For many years past, the great bulk of the new offerings in dollar value has consisted of bond issues that were purchased in the main by financial institutions such as banks and insurance companies. In this business, the security salesmen have been dealing with shrewd and experienced buyers. Hence, any recommendations made by the investment bankers to these customers have had to pass careful and skeptical scrutiny. Thus, these transactions are almost always effected on a business-like footing. But a different situation obtains in a relationship between the individual security buyer and the investment banking firms, including the stockbrokers acting as underwriters. Here the purchaser is frequently inexperienced and seldom shrewd. He is easily influenced by what the salesman tells him, especially in the case of common stock issues, since often his unconfessed desire in buying is chiefly to make a quick profit. The effect of all this is that the public investor's protection lies less in his own critical faculty than in the scruples and ethics of the offering houses. 3. It is a tribute to the honesty and competence of the underwriting firms that they are able to combine fairly well the discordant roles of advisor and salesman. But it is imprudent for the buyer to trust himself to the judgment of the seller. In 1959 we stated at this point, the bad results of this unsound attitude show themselves recurrently in the underwriting field and with notable effects in the sale of new common stock issues during periods of active speculation. Shortly thereafter this warning proved urgently needed. As already pointed out, the years 1960 to 1961 and, again, 1968 to 69 were marked by an unprecedented outpouring of issues of lowest quality, sold to the public at absurdly high offering prices and in many cases pushed much higher by heedless speculation and some semi-manipulation. A number of the more important Wall Street houses have participated to some degree in these less than creditable activities, which demonstrates that the familiar combination of greed, folly, and irresponsibility has not been exorcised from the financial scene. The intelligent investor will pay attention to the advice and recommendations received from investment banking houses, especially those known by him to have an excellent reputation, but he will be sure to bring sound and independent judgment to bear upon these suggestions, either his own, if he is competent, or that of some other type of advisor. Are there advisors? It is a good old custom, especially in the smaller towns, to consult one's local banker about investments. A commercial banker may not be a thoroughgoing expert on security values, but he is experienced and conservative. He is especially useful to the unskilled investor, who is often tempted to stray from the straight and unexciting path of a defensive policy and needs the steadying influence of a prudent mind. The more alert and aggressive investor, seeking counsel in the selection of security bargains, will not ordinarily find the commercial banker's viewpoint to be especially suited to his own objectives. We take a more critical attitude toward the widespread custom of asking investment advice from relatives or friends. The inquirer always thinks he has good reason for assuming that the person consulted has superior knowledge or experience. Our own observation indicates that it is almost as difficult to select satisfactory lay advisors as it is to select the proper securities unaided. Much bad advice is given free. Summary. Investors who are prepared to pay a fee for the management of their funds may wisely select some well-established and well-recommended investment counsel firm. Alternatively, they may use the investment department of a large trust company or the supervisory service supplied on a fee basis by a few of the leading New York Stock Exchange houses. The results to be expected are in no wise exceptional, but they are commensurate with those of the average well-informed and cautious investor. Most security buyers obtain advice without paying for it specifically. It stands to reason, therefore, that in the majority of cases they are not entitled to and should not expect better than average results. They should be wary of all persons, whether customers, brokers or security salesmen, who promise spectacular income or profits. This applies both to the selection of securities and to guidance in the elusive, and perhaps elusive, art of trading in the market. Defensive investors, as we have defined them, will not ordinarily be equipped to pass independent judgment on the security recommendations made by their advisors. But they can be explicit, and even repetitiously so, in stating the kind of securities they want to buy. If they follow our prescription, they will confine themselves to high-grade bonds and the common stocks of leading corporations, preferably those that can be purchased at individual price levels that are not high in the light of experience and analysis. The security analyst of any reputable stock exchange house can make up a suitable list of such common stocks and can certify to the investor whether or not the existing price level therefore is a reasonably conservative one as judged by past experience. The aggressive investor will ordinarily work in active cooperation with his advisors. He will want their recommendations explained in detail, and he will insist on passing his own judgment upon them. This means that the investor will gear his expectations and the character of his security operations to the development of his own knowledge and experience in the field. Only in the exceptional case, where the integrity and competence of the advisors have been thoroughly demonstrated, should the investor act upon the advice of others without understanding and approving the decision made. There have always been unprincipled stock salesmen and fly-by-night stockbrokers, and, as a matter of course, we have advised our readers to confine their dealings, if possible, to members of the New York Stock Exchange. But we are reluctantly compelled to add the extra cautious counsel that security deliveries and payments be made through the intermediary of the investor's bank. The distressing Wall Street brokerage house picture may have cleared up completely in a few years, but in late 1971 we still suggest, better safe than sorry. Chapter 11. Security Analysis for the Lay Investor. Financial analysis is now a well-established and flourishing profession, or semi-profession. The various societies of analysts that make up the National Federation of Financial Analysts have over 13,000 members, most of whom make their living out of this branch of mental activity. Financial analysts have textbooks, a code of ethics, and a quarterly journal. They also have their share of unresolved problems. In recent years there has been a tendency to replace the general concept of security analysis by that of financial analysis. The latter phrase has a broader implication and is better suited to describe the work of most senior analysts on Wall Street. It would be useful to think of security analysis as limiting itself pretty much to the examination and evaluation of stocks and bonds, whereas financial analysis would comprise that work, plus the determination of investment policy, portfolio selection, plus a substantial amount of general economic analysis. 1. In this chapter we shall use whatever designation is most applicable, with chief emphasis on the work of the security analyst proper. The security analyst deals with the past, the present, and the future of any given security issue. He describes the business. He summarizes its operating results and financial position. He sets forth its strong and weak points, its possibilities and risks. He estimates its future earning power under various assumptions, or as a best guess. He makes elaborate comparisons of various companies, or of the same company at various times. Finally, he expresses an opinion as to the safety of the issue, if it is a bond or investment-grade preferred stock, or as to its attractiveness as a purchase, if it is a common stock. In doing all these things, the security analyst avails himself of a number of techniques, ranging from the elementary to the most abstruse. He may modify substantially the figures in the company's annual statements, even though they bear the sacred imprimatur of the certified public accountant. He is on the lookout particularly for items in these reports that may mean a good deal more or less than they say. The security analyst develops and applies standards of safety by which we can conclude whether a given bond or preferred stock may be termed sound enough to justify purchase for investment. These standards relate primarily to past average earnings, but they are concerned also with capital structure, working capital, asset values, and other matters. In dealing with common stocks, the security analyst until recently has only rarely applied standards of value as well defined as were his standards of safety for bonds and preferred stocks. Most of the time he contented himself with a summary of past performances, a more or less general forecast of the future, with particular emphasis on the next 12 months, and a rather arbitrary conclusion. The latter was, and still is, often drawn with one eye on the stock ticker or the market charts. In the past few years, however, much attention has been given by practicing analysts to the problem of valuing growth stocks. Many of these have sold at such high prices in relation to past and current earnings that those recommending them have felt a special obligation to justify their purchase by fairly definite projections of expected earnings running fairly far into the future. Certain mathematical techniques of a rather sophisticated sort have perforce been invoked to support the valuations arrived at. We shall deal with these techniques, in foreshortened form, a little later. However, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. For the more dependent the valuation becomes on anticipations of the future, and the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. A large part of the value found for a high multiplier growth stock is derived from future projections which differ markedly from past performance, except perhaps in the growth rate itself. Thus it may be said that security analysts today find themselves compelled to become most mathematical and scientific in the very situations which lend themselves least auspiciously to exact treatment. Let us proceed, nonetheless, with our discussion of the more important elements and techniques of security analysis. The present highly condensed treatment is directed to the needs of the non-professional investor. At the minimum, he should understand what the security analyst is talking about and driving at. Beyond that, he should be equipped, if possible, to distinguish between superficial and sound analysis. Security analysis for the lay investor is thought of as beginning with the interpretation of a company's annual financial report. This is a subject which we have covered for laymen in a separate book, entitled The Interpretation of Financial Statements. 2. We do not consider it necessary or appropriate to traverse the same ground in this chapter, especially since the emphasis in the present book is on principles and attitudes rather than on information and description. Let us pass on to two basic questions underlying the selection of investments. What are the primary tests of safety of a corporate bond or preferred stock? What are the chief factors entering into the valuation of a common stock? Bond analysis. The most dependable and hence the most respectable branch of security analysis concerns itself with the safety, or quality, of bond issues and investment-grade preferred stocks. The chief criterion used for corporate bonds is the number of times the total interest charges have been covered by available earnings for some years in the past. In the case of preferred stocks, it is the number of times that bond interest and preferred dividends combined have been covered. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, there is no way to determine precisely the most suitable criteria. In the 1961 revision of our textbook, Security Analysis, we recommend certain coverage standards, which appear in Table 11.1. Our basic test is applied only to the average results for a period of years. Other authorities require also that a minimum coverage be shown for every year considered. We approve a poorest year test, A, for investment-grade preferred stocks. The same minimum figures as above are required to be shown by the ratio of earnings before income taxes to the sum of fixed charges plus twice preferred dividends. Note: the inclusion of twice the preferred dividends allows for the fact that preferred dividends are not income tax deductible, whereas interest charges are so deductible. B. Other categories of bonds and preferreds. The standards given above are not applicable to 1. Public utility holding companies, 2. Financial companies, 3. Real estate companies. Requirements for these special groups are omitted here. As an alternative to the 7-year average test, it would be sufficient if the bond or preferred stock met either of these criteria. It may be objected that the large increase in bond interest rates since 1961 would justify some offsetting reduction in the coverage of charges required. Obviously, it would be much harder for an industrial company to show a 7 times coverage of interest charges at 8% than at 41/2%. To meet this changed situation, we now suggest an alternative requirement related to the percent earned on the principal amount of the debt. These figures might be 33% before taxes for an industrial company, 20% for a public utility, and 25% for a railroad. It should be borne in mind here that the rate actually paid by most companies on their total debt is considerably less than the current 8% figures, since they have the benefit of older issues bearing lower coupons. The poorest year requirement could be set at about 2/3 of the 7-year requirement. In addition to the earnings coverage test, a number of others are generally applied. These include the following. 1. Size of enterprise. There is a minimum standard in terms of volume of business for a corporation, varying as between industrials, utilities, and railroads, and of population for a municipality. 2. Stock-equity ratio. This is the ratio of the market price of the junior stock issues to the total face amount of the debt, or the debt plus preferred stock. It is a rough measure of the protection, or cushion, afforded by the presence of a junior investment that must first bear the brunt of unfavorable developments. This factor includes the market's appraisal of the future prospects of the enterprise. 3. Property value. The asset values, as shown on the balance sheet or as appraised, were formerly considered the chief security and protection for a bond issue. Experience has shown that in most cases safety resides in the earning power, and if this is deficient, the assets lose most of their reputed value. Asset values, however, retain importance as a separate test of ample security for bonds and preferred stocks in 3 enterprise groups: public utilities, because rates may depend largely on the property investment, real estate concerns, and investment companies. At this point, the alert investor should ask, how dependable are tests of safety that are measured by past and present performance, in view of the fact that payment of interest and principal depends upon what the future will bring forth? The answer can be founded only on experience. Investment history shows that bonds and preferred stocks that have met stringent tests of safety, based on the past, have in a great majority of cases been able to face the vicissitudes of the future successfully. This has been strikingly demonstrated in the major field of railroad bonds, a field that has been marked by a calamitous frequency of bankruptcies and serious losses. In nearly every case, the roads that got into trouble had long been overbonded, had shown an inadequate coverage of fixed charges in periods of average prosperity, and would thus have been ruled out by investors who applied strict tests of safety. Conversely, practically every road that has met such tests has escaped financial embarrassment. Our premise was strikingly vindicated by the financial history of the numerous railroads reorganized in the 1940s and in 1950. All of these, with one exception, started their careers with fixed charges reduced to a point where the current coverage of fixed interest requirements was ample, or at least respectable. The exception was the New Haven Railroad, which in its reorganization year, 1947, earned its new charges only about 1.1 times. In consequence, while all the other roads were able to come through rather difficult times with solvency unimpaired, the New Haven relapsed into trusteeship, for the third time, in 1961. In Chapter 17 below we shall consider some aspects of the bankruptcy of the Penn Central Railroad, which shook the financial community in 1970. An elementary fact in this case was that the coverage of fixed charges did not meet conservative standards as early as 1965. Hence a prudent bond investor would have avoided or disposed of the bond issues of the system long before its financial collapse. Our observations on the adequacy of the past record to judge future safety apply, and to an even greater degree, to the public utilities, which constitute a major area for bond investment. Receivership of a soundly capitalized, electric, utility company or system is almost impossible. Since Securities and Exchange Commission control was instituted, along with the breakup of most of the holding company systems, public utility financing has been sound and bankruptcies unknown. The financial troubles of electric and gas utilities in the 1930s were traceable almost 100% to financial excesses and mismanagement, which left their imprint clearly on the company's capitalization structures. Simple but stringent tests of safety, therefore, would have warned the investor away from the issues that were later to default. Among industrial bond issues, the long-term record has been different. Although the industrial group as a whole has shown a better growth of earning power than either the railroads or the utilities, it has revealed a lesser degree of inherent stability for individual companies and lines of business. Thus in the past, at least, there have been persuasive reasons for confining the purchase of industrial bonds and preferred stocks to companies that not only are of major size but also have shown an ability in the past to withstand a serious depression. Few defaults of industrial bonds have occurred since 1950, but this fact is attributable in part to the absence of a major depression during this long period. Since 1966 there have been adverse developments in the financial position of many industrial companies. Considerable difficulties have developed as the result of unwise expansion. On the one hand, this has involved large additions to both bank loans and long-term debt. On the other, it has frequently produced operating losses instead of the expected profits. At the beginning of 1971, it was calculated that in the past 7 years the interest payments of all non-financial firms had grown from $9.8 billion in 1963 to $26.1 billion in 1970, and that interest payments had taken 29% of the aggregate profits before interest and taxes in 1971, against only 16% in 1963.3. Obviously, the burden on many individual firms had increased much more than this. Overbonded companies have become all too familiar. There is every reason to repeat the caution expressed in our 1965 edition. We are not quite ready to suggest that the investor may count on an indefinite continuance of this favorable situation, and hence relax his standards of bond selection in the industrial or any other group. Common stock analysis. The ideal form of common stock analysis leads to evaluation of the issue, which can be compared with the current price to determine whether or not the security is an attractive purchase. This valuation, in turn, would ordinarily be found by estimating the average earnings over a period of years in the future and then multiplying that estimate by an appropriate capitalization factor. The now standard procedure for estimating future earning power starts with average past data for physical volume, prices received, and operating margin. Future sales in dollars are then projected on the basis of assumptions as to the amount of change in volume and price level over the previous space. These estimates, in turn, are grounded first on general economic forecasts of gross national product, and then on special calculations applicable to the industry and company in question. An illustration of this method of valuation may be taken from our 1965 edition and brought up to date by adding the sequel. The Value Line, a leading investment service, makes forecasts of future earnings and dividends by the procedure outlined above, and then derives a figure of price potentiality, or projected market value, by applying a valuation formula to each issue based largely on certain past relationships. In Table 11.2 we reproduce the projections for 1967 to 1969 made in June 1964, and compare them with the earnings and average market price actually realized in 1968, which approximates the 1967 to 1969 period. The combined forecasts proved to be somewhat on the low side, but not seriously so. The corresponding predictions made 6 years before had turned out to be over-optimistic on earnings and dividends. But this had been offset by use of a low multiplier, with the result that the price potentiality figure proved to be about the same as the actual average price for 1963. The reader will note that quite a number of the individual forecasts were wide of the mark. This is an instance in support of our general view that composite or group estimates are likely to be a good deal more dependable than those for individual companies. Ideally, perhaps, the security analyst should pick out the 3 or 4 companies whose future he thinks he knows the best, and concentrate his own and his client's interest on what he forecasts for them. Unfortunately, it appears to be almost impossible to distinguish in advance between those individual forecasts which can be relied upon and those which are subject to a large chance of error. At bottom, this is the reason for the wide diversification practiced by the investment funds. For it is undoubtedly better to concentrate on one stock that you know is going to prove highly profitable, rather than dilute your results to a mediocre figure, merely for diversification's sake. But this is not done, because it cannot be done dependably. For the prevalence of wide diversification is in itself a pragmatic repudiation of the fetish of selectivity, to which Wall Street constantly pays lip service. Factors affecting the capitalization rate. Though average future earnings are supposed to be the chief determinant of value, the security analyst takes into account a number of other factors of a more or less definite nature. Most of these will enter into his capitalization rate, which can vary over a wide range, depending upon the quality of the stock issue. Thus, although 2 companies may have the same figure of expected earnings per share in 1973 to 1975, say $4, the analyst may value one as low as 40 and the other as high as 100. Let us deal briefly with some of the considerations that enter into these divergent multipliers. 1. General long-term prospects. No one really knows anything about what will happen in the distant future, but analysts and investors have strong views on the subject just the same. These views are reflected in the substantial differentials between the price-earnings ratios of individual companies and of industry groups. At this point we added in our 1965 edition. For example, at the end of 1963 the chemical companies in the Dow Jones Industrial Average were selling at considerably higher multipliers than the oil companies, indicating stronger confidence in the prospects of the former than of the latter. Such distinctions made by the market are often soundly based, but when dictated mainly by past performance they are as likely to be wrong as right. We shall supply here In Table 11.3, the 1963 year-end material on the chemical and oil companies use in the Dow Jones Industrial Average, and carry their earnings to the end of 1970. It will be seen that the chemical companies, despite their high multipliers, made practically no gain in earnings in the period after 1963. The oil companies did much better than the chemicals and about in line with the growth implied in their 1963 multipliers. 5 Thus our chemical stock example proved to be one of the cases in which the market multipliers were proven wrong. B. 2. Management. On Wall Street a great deal is constantly said on this subject, but little that is really helpful. Until objective, quantitative, and reasonably reliable tests of managerial competence are devised and applied, this factor will continue to be looked at through a fog. It is fair to assume that an outstandingly successful company has unusually good management. This will have shown itself already in the past record. It will show up again in the estimates for the next 5 years, and once more in the previously discussed factor of long-term prospects. The tendency to count it still another time as a separate bullish consideration can easily lead to expensive overvaluations. The management factor is most useful, we think, in those cases in which a recent change has taken place that has not yet had the time to show its significance in the actual figures. 2 spectacular occurrences of this kind were associated with the Chrysler Motor Corporation. The first took place as far back as 1921, when Walter Chrysler took command of the almost moribund Maxwell Motors, and in a few years made it a large and highly profitable enterprise, while numerous other automobile companies were forced out of business. The second happened as recently as 1962, when Chrysler had fallen far from its once high estate and the stock was selling at its lowest price in many years. Then new interests, associated with consolidation coal, took over the reins. The earnings advanced from the 1961 figure of $1.24 per share to the equivalent of $17 in 1963, and the price rose from a low of 381 halves in 1962 to the equivalent of nearly 200 the very next year. 6. 3. Financial strength and capital structure. Stock of a company with a lot of surplus cash and nothing ahead of the common is clearly a better purchase, at the same price, than another one with the same per share earnings but large bank loans and senior security ties. Such factors are properly and carefully taken into account by security analysts. A modest amount of bonds or preferred stock, however, is not necessarily a disadvantage to the common, nor is the moderate use of seasonal bank credit. Incidentally, a top-heavy structure, too little common stock in relation to bonds and preferred, may under favorable conditions make for a huge speculative profit in the common. This is the factor known as leverage. 4. Dividend record. One of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. 5. Current dividend rate. This, our last additional factor, is the most difficult one to deal with in satisfactory fashion. Fortunately, the majority of companies have come to follow what may be called a standard dividend policy. This has meant the distribution of about 2/3 of their average earnings, except that in the recent period of high profits and inflationary demands for more capital the figure has tended to be lower. In 1969 it was 59.5% for the stocks in the Dow Jones